Duggad, Head of Research Institutional Equities at Motilal Oswal, on the show right now. Hi Gautam, great to be speaking with you and welcome to ET Now. And recently, Gautam, a very interesting note by your team which says that the corporate profit to GDP, that number is standing tall at a 17-year high. Firstly, help us understand that what this ratio really implies and what this really means and what implications can it have on the Indian equity markets.
Hi, good morning. Thanks for having me. Yes, we just put out a note on corporate profit to GDP, which is our annual signature note. So allow me to explain it in a little bit granular fashion. So corporate profit to GDP basically reflects on the underlying earnings cycle. You would have seen in 2020, we had a corporate profit to GDP just in the middle of COVID at a 2.1%, which is where it bottomed out. In 2008, at the previous peak of earnings, the corporate profit to GDP was somewhere close to 5.1%. Right now, from 2.1 in 2020, we've already reached 4.7. This is at a new high, obviously, post the 2008 peak. This obviously doesn't include the unlisted names. This is just the Nifty 500 companies. If you add up all the listed companies, this ratio is somewhere close to 5.1%. And last year, if you looked at the similar sort of a corporate profit to GDP performance, it was trending somewhere close to 4.7. And then if you added the unlisted and listed, it was somewhere about 6.7 or 6.8%. The previous peak of corporate profit to GDP, if you sum up the entire listed unlisted universe, so 7.9% in 2008. We bottomed out, as I said, at somewhere about 1.92% in 2020. Right now, just the listed data is available for FY25, within which 4.7 is Nifty 500 companies, and rest of the listed companies put together is 0.4%. So we are at 5.1% in FY25. As the unlisted data comes by September, we will update that. For reference, last year FY24, the listed plus unlisted stood at 7.3. So I would think that this year that number would have moved closer to 7.5, but we are still 40-50 basis points below the previous peak. So the interesting thing to note here is that while we are already in the middle of an earnings upcycle which began in 2020, we think there are still a couple of years left for this entire upcycle to play out. And given that there is a preponderance of a lot of sectors which were hitherto not listed and they are listed now, so possibility of this ratio in the foreseeable future crossing even 8.5% is very much there. The other interesting thing from this report to note out is that the underlying nominal GDP as such doesn't have too much of a bearing, basically on the profit or corporate India's earnings performance. If you look at 2003 to 8, which was the previous big bull cycle on earnings, the underlying nominal GDP compounded at close to 15%, earnings compounded at 30%. Then 2008 to 20, that 12-year was an earnings recession, where the underlying nominal GDP compounded at somewhere close to 12.5% CAGR, but the corporate earnings compounded at a measly 4%. We were obviously impacted with so many issues in that 10-year period. Now, again, from 2020 to 2025, the nominal GDP is compounded at 10.5%, but the earnings have compounded at 30%. So GDP is broadly, underlying GDP is broadly trended in that 10, 12, 14% band over a 15, 17-year period. But corporate earnings have had a massive cycle, 30%, then 4%, now back at 30%. A lot of the high beta cyclical sectors have compounded to this rise from 2.1 to 4.7% in the 5 years. Metals, oil and gas. The biggest contributor has been financials, which is where the earnings upcycle has been massive post 2020. If I look at the contribution of BFSI alone, the BFSI profit to GDP ratio itself has moved from 0.46 to about 1.84%. So almost 40% of the incremental increase in corporate profit to GDP ratio has come at the behest of BFSI. So those are the broad points I wanted to highlight from this report.
But, Gautam, what I wanted to understand is, what do you think is actually aiding corporate profitability? What are the factors at play, and where is it that you think it could head next if these factors, continue to hold through for India Inc.?
Yeah, so like I mentioned, between 2020 to 2025, cyclicals have made a huge contribution. The banking profit itself, if I just look at my coverage universe for the banking profits, they have crossed close to they've crossed close to 6 lakh crores right now. BFSI. If you look at Nifty also, FY18, the Nifty profitability in BFSI bottomed out, if I remember well, somewhere close to 48,000 crores. That number has now reached 3.5 lakh crores. So that's the level of increase that we have seen. FY25, if I look at the broader coverage universe, 65 financial companies that we track, we had a total profit pool of 50,000 crores in FY18 and somewhere close to 1 lakh 10, 1 lakh 15,000 crores in FY20. That number is now 5 lakh crores. For context, this 5 lakh crore was the total profit pool of all 300 companies that we used to track. So what was the profit pool of 300 companies has now become the profit pool of just financials. So they have made a huge contribution. Then there are global commodities like metals, oil and gas. They've gone through their upcycle between 2020 to 2025. Then there are a host of other sectors which have come and contributed. Capital goods, which is completely absent from 2012 to 2020, has made a huge comeback. And we have seen how the stock prices have done. Going forward, as we expect the nominal GDP still to compound at 10 to 11%, we expect the earnings performance of corporate India will be in mid-teens. So somewhere about 14-15% is what we are projecting between 2025 to 2027. And I wouldn't be surprised if that magnitude of growth continues beyond 2027 to 2030 also. Right. So that's our expectations from a medium-term earnings point of view. We've come a long way from 2020 to 2025. What we used to be a profit of just 4 lakh crores for Nifty 500 companies has turned into 16 lakh crores in 2025. Right. So even if this were to compound at 14-15% over the next 5 years, I think there is a lot of wealth still to be created in Indian equity market.
That's the take. But Gautam, in fact, my next question was along those lines itself. In your note, you've written that you expect corporate earnings to outpace the GDP growth going ahead. What's driving this confidence overall? Because if you take a look at Q4 earnings, the most recent ones, we've had mixed commentary coming in across sectors where individual stocks have been doing well within a particular sector, but it's not like the overall sector across the board has done well. This can be seen across autos, across FMCG. What's the outlook going ahead, and what's driving this confidence wherein you believe that corporate earnings could, as soon as next year, overtake India's GDP growth?
In fact, I beg to differ. Q4 was a very strong quarter. The spread, the quality, the number of beats that we have seen in this quarter, we've not seen in any quarter of FY25. This was the best quarter of FY25. We've exited at a very good momentum. Versus expectation of 2%, you got a 10% growth. Out of 22 sectors for which we forecast earnings, 19 delivered numbers which were better or ahead of expectations. Out of 300 companies that we forecast earnings for, 220, so that is roughly 75% of the coverage universe, have delivered numbers either in line or ahead of expectations. This is a far better number because this number usually is between 60 to 65%. So whichever way you slice and dice the earnings, fourth quarter was one of the best quarters that we've had, both from an absolute earnings point of view, as well as the spread and quality and internals of that corporate performance. In fact, if you dig slightly deeper, out of that 10% earnings growth, mid-caps earnings have compounded, grown at 19% in our coverage universe, and we cover around 100 mid-caps. Around 85 to 90 large caps that we covered, they posted 10% earnings growth. And small cap earnings were flat ex of financials. So I think the fourth quarter earnings have set the pace now. We are entering FY26 with a good momentum. There is a lot of support from the macros coming in. RBI delivering 100 basis point of a rate cut. Government cutting income tax rate. Inflation trending close to 3%. That leaves more room for RBI in second of FY26 to cut another 25-50 basis point. Liquidity conditions improving. GST data is strong. Your e-way bills, all of those numbers are strong. So I think 12 to 15% earnings growth is not a very far-fetched expectations that we have. Yes, the sectoral mix within that 12-15% expectation that we have might change along the way. Some other sector will contribute versus what we are thinking right now. But broadly, I would also expect the capex cycle to revive. the large part of FY25 is spent bemoaning the slowdown in capex. But look at the March number. The government spent 2.4 lakh crores. For context, this number was the total annual spend in FY25, which we now spent in 1 month. April also began on a strong note. We spent 1.6 lakh crores in capex. So between March and April, we've spent close to 4 lakh crores. So slowly, capex spending will also come back in vibe. It might grow at 10-11% or maybe slightly higher because the government has budgeted about 10% growth for FY26 at about 11.5 lakh crore. We closed at 10.5 last year versus budgeted estimate of 10.2. Nobody would have thought that government will exceed the capex spend for FY25 if you had asked them in February or even first week of March. So March came like that big slog over where government completely, achieved the target and exceeded by 2-3%. So those are some of the contributing factors for earnings in my view. The only place where we have our reservations is on global commodities because they're completely difficult to forecast. The underlying mark-to-market on the commodity prices basis the moment that we are seeing in commodities, that takes a huge toll on Nifty earnings because commodities contribute 20% of the profit pool. So if you look at number 6 of commodities, even FY25, the Nifty earnings growth was about 10%. So that is what is giving us the confidence that given the many parameters which are in play at both macro and micro level on consumption, capex, financials, the 12-15% earnings growth that we are projecting for FY25 to 27 is in the realm of achievement.
Well, indeed, Gautam, and we almost agree to the fact that post-COVID, we have seen re-rating for many of these PSUs. Yes, government spending did play a critical role, but better execution was also something that helped fuel the stock prices. Given the fact that the government spending is still quite robust, but the PSU stocks, they are not doing that well. Do you believe in the next earnings cycle, like you're projecting already, select PSUs should participate once again? And if yes, then which are the pockets?
So actually, when you look at PSUs, the cohort, there are multiple subsegments within that. There's banking, there's utility, there's commodity, there is defense. If you look at defense, July 24, the peak defense market cap was close to 11 lakh crores. From there to February 25, the market cap came down to 7 lakh crores. So almost a 35% decline. Now, between February to June, that is a 4-month period, the market cap has crossed the previous high of 11 lakh crores. Now it's almost trending towards 11.5 to 12 lakh crores. So 70% increase in market cap in 4 months for defense PSUs. A large part of the defense market cap is contributed by PSUs. In the same breath, if you look at railways have had a phenomenal rally from 2021 to 2024. The combined market cap of railway plus defense used to be 2 lakh crores in July 21. It went to 18 lakh crores in July 24. From there, as I said, both the cohorts had corrected 30-40%. Within that, defense has rallied and crossed its earlier peak. Railway is still to cross. We've seen PSU banks also flatlining for almost a year now. So where are we positive? We are positive on select PSU banks, which is why still overweight on PSUs in our model portfolio. In financials, even though our bigger overweight stems from non-lending financials and capital marketplace where we are far more bullish. Then selectively in commodities, we like Coal India, we like Power Grid. So you cannot have a basket approach every time because the underlying undervaluation of PSUs, which were prevailing in 2020, large part of that got corrected between 2020 to 2024. A year and a half back, we had detailed that out in our PSU strategy note, where we said that despite the big rally in the market cap for PSU companies, the PSU index was still trading at 14-15 P, while its average used to be 8-9 times. I don't think the P has more room for re-rating even in defense stocks now, because now even defense stocks are trading at 40-50 P. The only place where valuations are very reasonable in PSU space today is PSU bank and some of these commodity stocks.
Okay, Gautam, so good having you on the show and getting in all that insight and where you think, India's earnings are headed and what is priced in right now. Good to